Hello students, welcome to the midterm exam 1 review part 2. In this part we will be discussing the chapter 2, 3, 4 and 5, and we have solved almost all types of problems that will be tested on the exam. So you can see that in chapter 2 we will be testing on journal, ledger and journal, ledger. So we'll be testing on journal, ledger and unadjusted trial balance, meaning you will be preparing the journals, okay, and then you will be posting them to the ledger account, and then you will prepare the trial balance. And we have videos on preparing the journal, ledger and trial balance, so please watch those videos. And then we will be asking for preparing the adjusting entries. And in this case, you know that we have practiced in the class two types of adjusting entries. The number one is normal, the normal one, and the second one is alternative method. So be careful about the alternative method. The one that is in our CRP, you can also find the same type of examples in CRP. And finally, you will be tested on closing entries. So first of all, let's see which accounts are closed at the end of the accounting period. So normally these three types of accounts are closed at the end of the accounting period. So all the revenue accounts, all expense accounts, and the net income or net loss. This type of these three accounts are closed. And let's see. So we have two types of accounts. Okay. So number one is the permanent account that are not closed. So they are called permanent accounts, and the accounts that are closed, they are called temporary accounts. Okay, so temporary accounts are closed. These accounts are closed. Okay, these accounts are not closed. So what are the temporary accounts? So let me change the ink color. So the temporary accounts are, say, in short, I call them REID, R-E-I-D. Okay, so R means revenue and E means expense and I actually net income or loss. Okay, and D means dividend. Okay, these accounts are closed, and these accounts are not closed, and they are the let me change the color. Okay, so E L A. So ELA, they are not closed. What are the accounts? They are equity, and L for liability, and A for assets. So these accounts are not closed. And how to close the accounts? Here are the templates of closing the accounts. The first one is to close the revenue accounts, and we will be closing the revenue accounts to the income statement. So the journal will be revenue accounts debit and income summary credit. Okay, let's have an example. Suppose our revenue is say, okay, let me erase this one. Okay, so think that our revenue, okay, think our revenue is 100. Okay, 100 is close to income summary. And to close the revenue, expenses, so income summary debit and expense account credit. Suppose expense is 60. Okay, and to close the net income, so what we have now, so if we prepare the income summary, so first one we have credit of 100 and second one we have debit of 100. So finally our balance is 40. So this 40 is balance of the income statement, meaning income summary. So income summary debit 40 and retained earnings credit 40. So to close the net income, so if we had say for example, if we had 110 of expense instead of 60, so we would have 10 loss. In that case, this loss should be close to the retained earnings debit and income summary credit. I hope you have understood. And now cash flow classification. This is from chapter number 3, right? Sorry, this is from chapter number 3. Okay, this is from chapter 3. Okay, so we have already discussed the 3 types of cash flow: operating, investing, and financing. So how do you identify a transaction, whether it is operating, investing, or financing activities? So first of all, let's see the operating activities. So operating activities actually affect current assets. So current assets or current liability. Okay, and investing activities will affect the long-term assets. Long-term assets. Okay, and financing activities will affect the long-term liabilities, long-term liability, and owner's equity. Okay, so I hope you have understood. Let's have some examples of, say, operating activities. So the example of operating activity would be, say, service revenue. Okay, so when we provide service, we either received cash or accounts receivable increase. So both of them are current assets, you can see. And now think about an expense. Suppose that workers have worked for us, but we have not yet paid. So in that case, what will happen? 2 things. Either we will pay cash, that is current assets, okay, or if we don't pay cash but workers have worked for us, in that case we will have a liability, that is the, say, salaries expense, meaning salaries expense debit and salaries payable credit. So salaries payable is a liability. And long-term assets in case of investment. Okay, so think about that. If we purchase equipment, machinery, building, property, plant and equipment, these are long-term assets, or if we sell the long-term assets. Okay, so that are our investing activities. And financing activities, long-term liabilities. Say for example, if we sign a note payable, okay, long-term note payable, 4 years, 5 years, more than 1 year, okay, that is a long financing activities. So, and owner's equity, when owners invest, or when we pay to the investors as dividend, those are. And now let's go to the indirect method of cash flow statement. And to prepare the indirect method of cash flow statement, we usually start with the net income. Okay, and we will have to adjust the non-cash items. So we will add all the non-cash items we have deducted from revenue but did not pay in cash. For example, depreciation. We have subtracted depreciation from our revenue, right? So from revenue, we have subtracted depreciation, but we did not pay cash. That is why we will have to add back depreciation. Okay. And now, and then all the items for which we have added with the revenues but did not receive cash, we'll have to subtract. For example, increase in accounts receivable. It means that we have added this amount of income or revenue in our revenue account, right? So, but we did not pay. We did not receive cash. Can you see that? So that is why what we will do, we have added this accounts receivable, increase in accounts receivable as a revenue, but we did not receive cash. That is why we will have to subtract this amount of revenue. So we will subtract this amount of revenue from our net income. Okay, let's see the pro forma indirect method of statement. Okay, so we are starting with net income, see that, and then we will be adjusting all the accounts. See, depreciation or amortization will be added, loss on sale of long-term assets added, gain on sale of long-term assets subtracted, increase in current assets other than cash subtracted, then decrease in current assets other than cash addition, meaning we will be adding, and then increase in current liabilities adding, decrease in current liabilities, so subtracting. And these are really easy. So sale of long-term assets, will be receiving money, and purchase of long-term assets, we will be providing money will go out. So that is why it is subtraction. And collection of notes receivable, so we will be receiving money, and loans to others, we will be paying money to outsiders. So this, and issuance of stock here, see, so when we issue stock, we receive money. That is why it is added. And sale of treasury stock, or if we sell the treasury stock, we receive money. That is why this amount of money will be added. And purchase of treasury stock, if we purchase treasury stock, then we will have to pay. So money will go out, and borrowing, money will come, payment, money will go, and then payment of dividend, money will go. So this way we actually reach to the net cash at hand. And the classified balance sheet, so this is from chapter 4. We need to prepare the balance sheet by classifying the assets and liabilities. For example, we'll be classifying assets at current assets, say cash, accounts receivable, inventory. These are the examples. Then property, plant, and equipment. These are their equipment, building, machinery, long-term assets actually. And current liabilities will include accounts payable, salaries payable. Long-term liabilities will be long-term note payable, debt, etc. And owner's equity, so it will be actually stock, meaning the capital plus retained earnings. Okay, these are. And here you can see an example of a balance sheet. Okay, so you can see that under the head current assets we have cash, petty cash, temporary investments, I mean short term. Then accounts receivable net, it means that we will be subtracting the um, uncollectible accounts, and then inventory, supplies, prepaid insurance. These are the uh, short term, meaning current assets. So all these are current assets. Okay, and here there is a one item that is investment. It is separately classified as investment. Okay, and then property, plant and equipment, we have land improvements, building equipment, less the accumulated depreciation. So property, plant and equipment, this is the net amount. So, and then intangible assets, some say goodwill, trade names, this is total. So other assets and total assets, this is the amount of total assets we have. And then uh, under the head liabilities we have current liabilities. Then see, you can see that notes payable, accounts payable, wages payable, interest payable, taxes payable, warranty liability, and earned revenue. So these are the current liabilities we have, these all these. And then long-term liabilities we have note payable, bonds payable. And so only when you will see that there is a note payable, it doesn't indicate it's long term or short term, but definitely it will have the time frame. So if the note payable is for more than 1 year, okay, that is a long term liability. And if it is meaning if you have to pay the note payable within 1 year or within the operating cycle, so which one is longer, you will that will be classified as current liability. Okay, that is total liability. And the stockholders equity, we have common stock, we have retained earnings, we have accumulated other comprehensive income, we have treasury stock. So finally this is our liabilities and owners equity. And from chapter 5 we have already solved this kind of problems in our class. So the percentage of completion and multiple performance, and you will also find similar type of problems in our CRP1. Okay, so I hope you will have a good practice from the CRP and from our class works, and you will be fine for the exam. So please review in-class problems and CRP for more practice. So I'm sure all of you will be doing better in the exam, and even if you have any question, please let me know. I will be happy to answer all of your questions. Thank you and good luck.